Guys, welcome back to another video analysis. As we discussed on Monday, today we're going to be talking about why I believe that the next 2-3 months, potentially August, September, October, could be kind of weak for markets. We could see a pullback, perhaps something larger, and so let's just go over some of the macro things that I'm looking at, starting of course with the most important of all, which is of course liquidity. Now, as we'll point out in the next slide, liquidity has been coming down, and traditionally, this is generally seasonally quite a bad time for liquidity. This is normally the time when we obviously get that debt ceiling raised or suspended, and as we can see, that has a pretty significant effect on both yields and Treasury and the dollar index, and of course the TGA balance. Okay, so this is the time now when the TGA balance is being refilled. This is of course taking liquidity out of the market, and this generally has an effect where we see yields tend to rise a little bit at this point, and also the dollar tends to strengthen. Okay, and it's pretty interesting because we have seen the dollar form somewhat of a convincing bottom in the last couple of days, so we'll see if this continues. So again, this could definitely be an interesting headwind for markets going into the next couple months. Now, we've actually seen, according to this chart of global M2 money supply, we've actually seen an interesting, we've already seen quite a pullback in the money supply over the last few months. Now, what we have here is the M2 money supply overlaid with Bitcoin with a 90-day offset, right? So the idea here is that Bitcoin, once you offset the M2 chart, we can see that it actually holds a pretty strong correlation with Bitcoin. Now, this would actually suggest is that we could see Bitcoin continue to rally maybe through August, but maybe going into September or October, we would expect to see at least a bit of a pullback in crypto and global liquidity, and of course, potentially liquidity could fall even further. But that, of course, also depends a lot on what happens with the Federal Reserve. Now, we have seen that there isn't going to be an interest rate cut right now, probably in September, but again, that is still a little bit far away. Now, secondly, and also very importantly, and something that we've talked about it as well before, but the market right now is overlooking the risk of tariffs, in my opinion. Even though yes, we've seen some deals being struck with Europe and with some important countries, the effective tariff rate is a lot higher than it used to be. We're also already seeing substantial. Trump has been boasting about the fact that they're getting all these revenues from tariffs, but the other side of the coin to understand is that these revenues are basically a form of tax, right? It's a consumption tax. It's equivalent to a consumption tax, and this is again kind of draining fiscal stimulus from the economy, and not necessarily good for the economy. An economy which, as we'll see in the next point, is already weakening. Now, this is a chart from George Robertson. He's been on the podcast a couple of times. A great guy. Very interesting views. He was definitely very bullish going into this year, and very much on the right side of this bull market. And now he's turned very bearish. Part of this is, of course, because of tariffs, basically, and the way he estimates. We can see in this chart NGDP, PC, DSPI, which is disposable income. We can see that that's already been declining. He actually argues that we're already in a recession, and to be fair, George has put his money where his mouth is. He says he's short the market right now. Pretty interesting. I mean, I think he's definitely has some political bias against Trump that may or may not be clouding his judgment somewhat, but definitely very interesting and someone I respect a lot, whose opinion I respect a lot, and definitely something that we need to look into right now, especially with markets making all-time highs, and we're starting to see these cracks, right? Similarly, we can see GDP hasn't begun to roll over yet, but we have seen rollover is the percentage of GDP which is attributable to final sales to private domestic purchases. And this, some macroeconomists kind of argue that this is kind of somewhat of a leading indicator that's really kind of showing the strength, or rather in this case the weakness in these GDP numbers, right? Now, number 4 is employment. Again, employment, we did at one point see some weakness in employment last year, triggering that SAM rule. Since then, it's kind of stabilized, but right now it's a bit of a strange stalemate, right? I think the consensus now is that kind of like with the housing market, it's kind of like it's all a bit frozen, on the one hand, firings aren't exactly high, but at the same time, it's beginning to be harder to get a job. Job openings per unemployed person, as we can see, the ratio right now is coming close to 1. Okay, so meaning 1 job opening per unemployed person. Now, again, this ratio doesn't have to be above 1 necessarily, but of course, when it comes down, it is a symbol that, obviously things are weakening, and they could begin to turn at some point. Housing, of course, also beginning to roll over, and basically, again, this is something that a subscriber asked me about before, and again, this idea that right now, we're seeing kind of the market is kind of frozen. It's failing to readjust quickly because obviously buyers locked in mortgages at low rates, so they're in no hurry to sell, and now people are kind of waiting for lower rates, so it's kind of a bit of a stalemate. But we are seeing generally housing rolling over, and this is especially worrying in the face of what could be higher long-term yields coming up. Okay, so what do we expect? Going to discuss this in the next section. This is just for subscribers, guys, but if you're interested, please consider signing up. Okay, guys. Now let's move on to how we play all of this into the coming months, what I expect in terms of technical levels, and how we can kind of prepare and